I pulled up the performance data for major gold mining stocks against spot gold prices and saw something that should not be possible in a healthy market. Gold was up significantly. The miners were lagging, not just underperforming modestly, lagging by a margin that historically would have been called irrational. And that is not what you are hearing on financial television. Because on financial television, the story is simple: gold up, miners up; gold down, miners down. That is the relationship that every retail investor who buys miners for gold leverage has been told to expect. But right now, as I am recording this, that relationship is breaking down. And the breakdown is not noise, it is signal. It is telling you something specific and important about the mining industry, about margin compression, about cost structures, and about why the leverage most investors think they are getting when they buy gold miners is not the leverage they actually have right now. I am recording this right now from Los Angeles, and I want you to comment what day and date you are watching from, because this divergent story is still developing, and the timeline matters for understanding when it resolves. And real quick, if you value this kind of analysis that goes past the surface narrative and reads what is actually happening in the underlying businesses, subscribe and comment FinTalk OG so the algorithm knows you want more of this. Now here is the problem that is flying around in mining investment circles. Gold miners should be the leveraged play on gold. When gold goes up 10%, the theory says miners go up 20 or 30 because their profit margins expand disproportionately. That is the textbook case. That is why mining ETFs and individual miner stocks traditionally attract investors who want gold exposure with extra upside. But when you look at the actual numbers right now, that leverage is not showing up the way it should. Gold is at historic highs, and the miners are not performing like businesses operating at historic highs. They are performing like businesses fighting their own cost structures. And the gap between where the miners should be given the gold price and where they actually are, that gap is the story. So I am going to break down three things. First, what is actually causing the divergence between gold prices and mining stock performance, what the cost dynamics look like, and why margins are not expanding the way the leverage model predicts. Second, whether this divergence is temporary or structural, and what has to change for miners to close the gap with gold. And third, what this means for how you should think about adding mining exposure to a precious metals portfolio right now. So let's start with what we can verify. Gold mining is a capital-intensive, operationally complex business. The profitability of a mining company depends not just on the gold price, but on what it costs to get that gold out of the ground. That all-in cost, which the industry calls AISC, or all-in sustaining cost, includes labor, energy, equipment, chemicals, water management, reclamation obligations, and sustaining capital investment. And right now, as I am recording this, AISC across the industry has risen significantly over the past several years. Labor costs are up, energy costs are up, reagent costs are up, equipment and parts costs are up. Mining inflation is real, and it has been running higher than general consumer inflation in many cases, because the inputs that miners depend on, diesel, explosives, steel, specialized labor, those have had their own supply constraints and cost pressures independent of what CPI is doing. So here is the math that explains the divergence. If gold goes from $2,000 to $3,000 an ounce, that is a 50% increase in the revenue per ounce. But if the cost to produce that ounce went from $1,200 to $1,800 over the same period, the margin per ounce went from $800 to $1,200. That is a 50% increase in absolute margin, which sounds great. But the stock market is pricing miners on multiples of those margins. And if the market believed costs would stay low while gold prices rose, it expected margin expansion of 100 or 200%. When costs rise alongside gold, the expansion is smaller than expected. The leverage disappears. The stock underperforms. That is the mechanism behind the divergence. It is not manipulation. It is not conspiracy. It is cost inflation eating the leverage that the investment thesis was built on. Here is the clean way to think about it. Imagine owning a lemonade stand where you sell lemonade for $5 a cup. Your lemons cost you $2. Your profit is $3. If lemon prices go up to $3 and you raise your price to $6, your profit is still $3. You are not better off, even though your revenue went up. That is what is happening to gold miners when gold prices rise, but operating costs rise with them. The top line goes up, but the bottom line does not expand proportionally. And investors who bought miners expecting the lemonade stand to print money when lemon prices rise, they are disappointed when the stand owner is paying more for lemons too. Now here is where it gets more interesting. The divergence is not uniform across all miners. Large, well-capitalized miners with long-life, low-cost deposits, the ones with modern, efficient operations and strong balance sheets, those are handling cost inflation better than smaller junior miners with aging mines, high strip ratios, and thin margins. The premium for quality in the mining sector has never been higher. A low-cost senior miner with AISC in the low to mid-hundreds per ounce is a very different animal right now than a mid-tier miner with AISC approaching the 2000s. Both are called gold miners. They are not the same investment at all. Here is a question for you. If you are buying a gold mining ETF for leveraged gold exposure, do you know the average AISC of the miners in that ETF? If you do not, you might not have the leverage you think you have. Drop a comment telling me which miner or ETF you hold and why you chose it. I read every comment and want to understand how people are building this exposure. Now here is the skeptical alternative. Could miners re-rate sharply higher from here if costs stabilize while gold prices stay elevated or move higher? Yes, absolutely. If energy prices moderate, if labor markets ease, if equipment supply chains normalize, the cost pressure eases and the leverage reasserts. Miners then start looking cheap relative to the gold price, and institutional money rotates in, compressing the valuation gap. That is the bull case for miners from current levels, and it is genuinely plausible. Here is how it can fail. Energy costs are not falling structurally in a world of underinvestment in oil and gas. Labor in mining regions is not becoming cheaper, and the permitting and regulatory environment for new mine development is not getting easier. So the cost pressures are not entirely cyclical. Some of them are structural, and structural cost pressures do not resolve in a single commodity cycle. They are baked into the operating economics of the industry for the medium term. And I am going to say something that might annoy both sides. Miners can be both correctly priced relative to their current margins and significantly undervalued relative to where gold might go. Those two things can coexist. If you think gold goes to $6,000 and costs do not double to match it, miners at current prices look incredibly cheap. If you think costs keep rising with gold, miners at current prices are appropriately priced for mediocre margin expansion. The thesis depends entirely on your view of cost trajectory relative to gold price trajectory. And most retail investors who buy mining ETFs for gold leverage have not done that math. They have just bought the concept without stress, testing the underlying economics. Now let's map two plausible paths without pretending we can predict the exact candle. Path 1. Costs stabilize while gold continues higher. The margin expansion that the leverage model predicts starts showing up in earnings reports. Institutional money, which has been underweight miners relative to historical norms, starts rotating back in. The gap between gold performance and miner performance closes. Miners start providing the 2 to 3 times leverage on gold moves that investors expected. That is a significant re-rating from current levels, and it rewards patient holders who sized in before the institutional rotation. That is within the set of things this market is capable of producing. Path 2. Costs stay elevated and miners continue to lag gold. The divergence persists for another year or two. Investors in mining ETFs get frustrated by underperformance relative to simply owning gold directly. Capital flows rotate out of miners and into physical gold or gold ETFs. Miners trade at a persistent discount to their historical relationship with gold, and only when a new generation of lower-cost mines, the ones currently being developed and not yet producing, come online does the structural cost picture improve. That is a longer wait for miner bulls, but it does not invalidate the eventual thesis. Here is what to watch. First, watch quarterly earnings reports for AISC trends. If all-in sustaining costs are stabilizing or declining, that is the green light for margin expansion. If they are still rising, the divergence continues. Second, watch energy prices, specifically diesel, because it is a major input for every mine on Earth. If oil stays elevated, mining costs stay elevated. If oil weakens, one of the biggest cost pressures eases. Third, watch institutional flows into mining ETFs like GDX and GDXJ. If large money is flowing in, the re-rating may be starting. If flows are tepid or outward, the rotation has not begun. Fourth, watch merger and acquisition activity in the mining sector. When big miners are buying smaller miners at premiums, that signals the big players believe current values are understated. That is a forward indicator of institutional confidence. So what do you actually do with this information? Here is a simple action plan. No drama. Step 1. If you own mining stocks for gold leverage, do the AISC math for your specific holdings. Know what cost level they are operating at and what gold price is required for meaningful margin expansion. If you have not done that math, you do not fully understand what you own. Step 2. Consider tilting your mining exposure toward low-cost senior producers rather than junior miners with thin margins. In a high-cost environment, the low-cost operators are the ones who actually deliver the leverage. Step 3. Do not abandon miners entirely because of the current divergence. If gold continues higher and costs stabilize, the catch-up trade in quality miners could be significant. But size it for patience, not for quick validation. Step 4. Maintain some direct gold exposure alongside your miners. If the divergence persists and miners underperform gold for longer than expected, the direct gold position still captures the thesis. The miners are the leveraged bet on the thesis. The physical or gold TF is the thesis itself. Now here are my questions for you. Do you think gold miners close the performance gap with spot gold in the next 12 months, or does cost inflation keep the divergence wide? And do you prefer individual miner selection over mining ETFs, and if so, which names are you watching? Drop your answer below and remember to include what day and date you are watching from. Subscribe and comment FinTalk OG so I know you want updates when earnings season reveals whether the cost trend is finally turning. And share this with someone who bought a mining ETF expecting leveraged gold returns and is confused about why it is not working the way they expected. All right, take care of yourself, and I will talk to you soon. And just so we are crystal clear, this is educational content. It is my take based on publicly discussed information and my own reasoning, and it is not personal financial advice. I am not your advisor. I do not know your goals or your risk tolerance, and I could be wrong. Do your own homework. Consider your situation, and if you need personal advice, get it from a qualified professional who knows your situation.